world of financing is continually changing. But now during COVID, there's even more volatility and uncertainty. Today, we're going to be talking with Josh Moorvitch. He's a real estate investor and broker, and he started his own firm about 13 years ago. He's done $1 billion worth of transactions in almost 1,000 deals. Let's hear what he has to say. All right, so Josh, thanks so much for joining me on this interview. I really appreciate it.
My pleasure. Good to be here.
Yeah, so it's like we're Trojans reconnecting. You know, remember way back when we both started out at USC, and I've known you for several years now and watched your business bloom and grow over the years. And now you've done almost 1,000 deals worth of financing at over $1 billion worth of transactions. So I'm really excited to kind of hear about what your experience has been with that. And also like kind of where we're at with COVID. I know things are changing a lot. And so we got a lot to dive into. So thank you for joining us. And I thought maybe we could just start out a little bit more about your background and JDM and how it came to be.
Pleasure. Pretty loaded question. So let's start from the top. Been in financing and specifically real estate financing, I think coming up on 16 or 17 years. I got into it. I transitioned from mergers and acquisitions in corporate finance, where I worked for a company that was doing purchasing and selling and buying up of nursing homes and retirement homes and dealing with the public markets. And there was a lot of pressure in that. And I needed something that was just more fulfilling, stuff that I can actually get my hands around. And I dealt with a lot of mortgage brokers at that time. And I transitioned to a broker, a small boutique shop in Beverly Hills, and he handed me a phone and a desk, and he said, "Good luck." And in my first year, I put together over $40 million of financing, and my angle was, I knew commercial financing, I understood it, but I never understood residential financing. So I learned both and used that as my niche. That JDM Funding now does commercial and residential financing. Most mortgage brokers and bankers either focus on residential or focus on commercial. My goal was to put both together because most of my clients had both types of property. So why should I be referring business out to others? Everybody should be referring in-house. And that was the niche I took. And I did that at this boutique shop in Beverly Hills for 5 or 6 years. And then in the heart of the crash of 2009, May of 2009, I opened the doors of JDM Funding Corporation, where everybody thought I was crazy. How can you do such a thing? Using my relationships, using my network, like a good Trojan, I put together a location, an office where I'm at right now, coming up on 12 years of JDM Funding this May.
Wow. That's great. So you thought like May 2009, you're like, all right, now is the perfect time to start a financing company. You must have had it like in plan for a while, and then it just happened to be right after the financial crisis is when it just happened to be, right?
So you're correct. I mean, it was always on my mind to start my own company. I was the highest producer at this other mortgage company. And May of 2009, my third daughter was born. I actually have 5 girls, and we just had twin boys a couple of years ago. So we're a family that has a lot of blessings. And my daughter was born May 6th. I made the decision that's the time to open the company. May 9th, we were incorporated. May 10th, the doors were open and business was started. And in our first year, I think we did maybe 1 or 2 deals. It was pretty crazy. But while everybody else was closing their doors, we were opening, and I was creating market share and networking and telling people about what we were doing. And thank God, it's been very successful since.
Well, I was just say, with all those kids you have no choice but to be successful. You don't have a choice, buddy.
Amen.
Oh, man. Well, look, I mean, experiencing from the lending side of the world and going through the financial crisis and you know, the US kind of crawling out of that. And now as we film this, we're, you know, in the middle, maybe towards the tail end of a pandemic. What have you seen going through these like 2 really big cycles, and maybe specifically like more so, what do you see now in COVID? How is your world changing with respect to lending?
So the crash of 2008 and 9 was a completely different, I think, a different event for the real estate world than what we're dealing with today. Back in '08 and '09 and 10 was really a bank failure. I mean, we had issues with banks being able to stay open. They weren't liquid enough. We had the government pumping, I think it was called TARP money back then, trying to make sure that there was enough liquidity in the banking system so the entire system didn't fall apart. That had an effect both on interest rates, both on the real estate level. So you had crashing rates, you had crashing real estate prices, things that were properties were underwater, both in the commercial sector, both in the residential sector. Underwater meaning that the value of the loans were higher than the value of the properties. The government was introducing stuff like HARP loans, where they would still allow refinances, and the government was buying up a lot of the mortgages to kind of keep things going. So at that point in time, I think you just had a crumbling from within that nobody, I mean, a lot of people predicted it because of all the different types of mortgages and stuff that were going on, but nobody thought the effect of that would have been that massive, and the stock market crashing as well. I think over the last year and a half with this pandemic, we're seeing different parts of the real estate market being exposed that were already on their way having issues. For example, commercial real estate. We see a lot of issues with retail already for the last couple of years, where you have companies like Amazon and other, a lot of e-commerce going on, where people are not going to stores as much, and the retail has been getting hit pretty hard. I think COVID just expedited that. So companies that were already on their way out or struggling to make things meet, they got slammed, and that had an effect both on the commercial real estate, the retail side, and we're still seeing major issues. I think that's the next shoe that's going to drop, because there's just a ton of space that's out there that is not occupied because of restrictions. They're not being financed. They're not going to be able to return. You have a lot of issues with restaurants. I don't know exactly what the statistic is, but they're saying the majority of these restaurants will not come back. You have a lot of healthcare facilities like gyms and care centers and all that have major big boxes as well, that are huge leases, but they're not open. And will people go back to those settings when they've been working out in their homes for a year? Who knows?
Yeah.
So that retail side has really taken a punishing, and financing itself in that space is not even really available unless the majority of the space may be used by essential businesses like banks or a dialysis center or a nice supermarket that's been there for a long time. Otherwise, the financing for those types of properties are just not there, or very low leverage. Over the last year, we've seen a lot in multifamily, which is apartment lending. Apartment lending, the rates have come down a lot over the last couple of years, specifically over the last 12 months. But the other issue with the multifamily is where we've had different government rules and stepping into the landlord game and putting a hold on the ability to raise your rents, the ability to evict people that are not paying their rents, the ability to foreclose on properties. So you have landlords that have these properties, and they have situations where tenants are not paying and they cannot go after the tenant. Court systems are not really available yet. And all these moratoriums on that have really put a noose, if that's the right word, around the landlord. So that's been very difficult. Now, the banks have been working through it. There's a lot of different financing now in multifamily. There may be mitigating factors in the financing where we set up interest reserves for a couple of months on properties that may have some issues. Properties that don't have issues may have zero restrictions of interest reserves. And even to the larger deals from Fannie or Freddie Mac or agency deals where they're having 12 months of reserves, both for taxes and insurance as well as for mortgage payments. So each lender is taking a different approach, but the financing is cheap. You can still get cash out. You can still buy into properties to reposition them. It just has to be done correctly with proper timing. I would say under multifamily, what's very interesting, where people would say buy in the best areas like Beverly Hills or West Hollywood, it's actually those are the properties that are having the biggest issues, as opposed to properties that may be in areas like South LA or Compton or Culver, areas around Culver City, and areas that have lower rents, because those properties everybody's paying. They know that the market rent is way above where they're at. There are also subsidies from Section 8. So those landlords are actually doing very well. Yeah. It's the higher end where you have rents of $3,000 or $4,000 a month where they can't pay. And on top of it, they can't be evicted. So the owners on those properties in Santa Monica and other areas, they're really hurting, and they're having almost like a 20% economic vacancy there. And that's where we're seeing a lot of the issues in multifamily.
Yeah. So, I want to dive into that a little bit because obviously CSQ Properties, we're pretty big in the multifamily space. My experience has been exactly what you're talking about. We've been buying buildings in Long Beach, and they're like a C-class building, and we improve them up to a B-class building, and they've been doing great. I've got, we're 100% occupied and paid up on 3 of the buildings, and on one of them, we're like 98.5%. Collections. And this is like from March all the way until today. And actually, to your point, literally just today, we just got one of the tenants that was behind got LA County funding for their past due rent. So now I can actually say we're 100% collected through all of COVID now. But some of that was, to your point, the LA County stepping in and helping some of these tenants that are in need. So we've been doing well with the C and B class apartments, but I've been noticing that on the banking side of things, some of those requirements are going up, the liquidity reserves, even though those interest rates are really low, 3.5% to 4%, really low, but they're requiring higher liquidity reserves in the case that the tenants aren't paying, and also recourse loans are going back on the landlord and saying, hey, you got to pay your mortgage. And so these loans, they are recourse loans. You're guaranteeing the loans. You got to have big reserves, deeper pockets to make these deals happen. But there's still investment money to be made. So what are you seeing from your perspective on these multifamily spaces and lending in terms of additional requirements besides just like a liquidity reserve or interest reserve? Are there other requirements that you're seeing out there?
So let's take that question and break it down in 2 parts. Let's focus on the overall new rules per se for multifamily financing, where in the past, it's stated loans essentially where you can borrow money on apartment buildings. Not all lenders require tax returns. Essentially, they would like to see that you had a 10% of whatever the loan amount in liquidity. So for example, if you were borrowing $1 million, they would like to see at least $100,000 of reserves in your bank. So those restrictions or those guidelines have always been there. What we're seeing today is where in the past we would focus 99% on a building and its ability to cash flow and its debt coverage ratios. Today, I would say it's probably 70-30, where it was 90-10 or 99-1 per se on the apartment building and the individual. We're seeing now 70% on the building and 30% or so on the individual or individuals who are buying this property. What's their ability to have some cash left over? Is it maybe more 15 or 20%? Do they have additional abilities to earn cash flow? So for example, if somebody's only living off their apartment building rent, as opposed to maybe they have a day job and they also have W-2 income or some other type of an earning, that if this building didn't produce for a couple months, they still have a cash flow that can come in and subsidize the building. So underwriters are getting a little bit more creative to figure out things. I think it's actually a great thing, because instead of underwriting just getting stuck on a building right now where, it could be very bleak at times, trying to mitigate that and understanding the individual and understanding the power and the strength behind those individuals and the track records and whatever else that they have going on, I think that actually helps the financing now So we're doing interesting things now for borrowers. And I'll give you an example. I don't want to get too technical, but when we underwrite a property and we have what we call debt coverage ratios, which means when you take your net operating income and you apply a ratio to it of how much money for debt do you have for the income. So for example, if I said there's a debt coverage ratio of $1.25 of 1.25, it means I would like you to have $1.25 of income for every dollar of of debt that you're borrowing or a payment of debt. So in that process, if somebody had a building that they've had in their family, let's say for 20 years, property taxes on that building may have been very, very low. Say the property's worth $5 million, but they may have purchased it for $1.5 million. The property taxes may be very low. What underwriters do is they will apply a current market tax rate to that property or to what the market would be today to really stress that property, and they would limit the loan dollars out. And their mindset is if we ever had to foreclose, at least we're in today's property taxes, so we're actually cash flowing. So we've actually been working now with different underwriting groups and creditors where they're allowing us to use the actual property tax versus market property tax. So this is helping the individuals that have properties for a while. Their property taxes are significantly lower than what market value may be, which helps them get more loan dollars out on cash out and specifically on refinances, tap into that equity in the property.
Yeah. Yeah, I mean that's helpful for the refis, but for people like me that are buying the buildings, we've got a new basis we got to deal with. So we are still dealing with that new tax basis. But speaking on the debt coverage ratios, are we still at about 1.25? Is that what you're seeing in there?
I would say the average is 125. We've seen some banks that are getting aggressive at 120 and 115 again, but the way they're mitigating it is by putting more interest reserves or more impounds on the loan. So, excuse me, I think at the end of the day, once you shake it all out, it's pretty much evening itself out at the 125 level.
Yeah.
And on the purchases, there is financing available. We're still very active in it. And especially for people that are buying properties and trying to reposition them, we have different earnouts in place. So as they get rents up, they're able to tap into more equity. We have a lot of, on the purchase side, financing that has no prepayment penalty for regular commercial financing. And that's unique. I'm sure, as you know, most of the loans you've ever done have all had some type of a step down prepay.
Yeah.
But buying property at these low cap rates right now, where essentially you're putting down almost 40%, sometimes more, depending in the market you're buying at, having a no prepayment penalty option is awesome, because as soon as you are able to turn that building and have a more stabilized rent, we can refinance that again to access that capital or the equity out of the property and not have to worry about some significant significant prepayment penalties on those refis.
Yeah, I mean that's one of the things I always found or admired about your company is you guys really have your hands in a bunch of different areas, and you do it well. And so I've always been admired that, because normally people will tend to specialize, but you guys have been able to offer a variety of financing deals. You even do your own in-house lending now, direct lending. Which is great. It's really why I wanted to get you on the call here, so that we could kind of dive into your brain, because you've seen so much. So across these different platforms where you do a variety of different lending, what have you seen in terms of transaction velocity over the last 12 months? Have you seen things picking up, slowing down in terms of your lending?
So thank God, we're blessed. I would say last year, 2020, was the best year of JDM funding.
Wow.
So while people were hurting out there in different businesses, and I don't take that lightly, thank God for us, we were very, very busy. I'd say on an average year, we probably do, I do about 80, 90 deals. I think last year we did somewhere around 100 to 120 deals. We did over $150 million of financing last year alone. We saw a lot of activity in the residential space. So we also are a full service on all 1 to 4 unit financing. So homes, duplexes, triplexes, fourplexes. We offer from the basic traditional 30-year fixed money to more complicated investment properties, LLCs, trusts, irrevocable trusts, and very complicated transactions. But that space has been very, very busy. We also do a lot of hard money and bridge financing, which may be used for either people are buying property that's not stabilized yet and needs to be positioned properly. Maybe they need cash out for a quick closing. Potentially, I mean, we've seen a lot right now where retail, the financing hasn't been there to take out regular bridge loans or hard money loans or any other type of financing. And we've had to come in and provide a hard money loan or a bridge loan, depending on what it is, on retail because of the limited lending from the commercial banks as well. So we've seen a lot this past year, and it's definitely spilled into 2021. So I'd say we're doing great, thank God, and we're actually gearing up for another strong 2021. We have been seeing a bump in the treasuries since the election day, and specifically also since January 1st. So I think the treasuries have more than doubled since November 4th. And what that means in English is that interest rates have begun to climb. And we've seen a lot of movement in a north direction over the last 45, 60 days. It's still relatively low no matter how you look at it. But I think there's some fears of inflation out there. The rates are coming up, but I don't see how they can go up too much because eventually the government is the biggest debt holder that needs to make its payments, as well as other countries paying their debt to the United States. So if that rates get too out of control, that can really have a major effect on all the markets. So I think this bump is something we've been anticipating, but overall rates are still cheap. I mean, we're doing traditional 30-year fixed loans still in the 2% range. We quoted one today for 1.99 on a 15-year fixed. Wow. So that's pretty much free money. And then multifamily is still very well priced. And I think even with all this money out there, hard money has come down as well, where typically it may have been 9 to 10%. We're seeing deals at 8 to 9 and even 6 to 7 and 7 to 8, depending on leverage and quality of assets. So I think overall the market is still buzzing. It's still doing well. But I'm still looking at retail to see what's going to happen there. Owner-occupied financing is doing very well. So people that have their own space, doctors buying their own practices, warehouses, industrial, that financing is there. It's very active and priced very well as well.
Yeah. So if you had the Josh Moorvitch crystal ball there over the next 12 months, do you see interest rates continue to climb a bit, or do you think it'll plateau? Where do you think it might go in the next 12 months?
I didn't anticipate this much in the last 60 days for the whole year.
Okay.
But I would say if I've just been in this for a long time, this has been a lot of movement, and I wouldn't be surprised if we see a crash again as far as the rates taking a little bit of a dip from where they are. I think as of today, we're at 1.45 or 150 on the 10-year treasury. The market crashed today, but the yields were up 5%.
Yeah.
The 5-year treasury was up 7%. Go figure. Usually when the market is crashing, the money is running away from the stocks, from the equities. They're running to bonds for safety. So the bond guys don't have to put up too much yield because they're coming there anyways. But it's a reverse correlation. So you've got the market crashing and the yield going up, which is not something you see very often.
Yeah.
I would say we're probably going to be staying where we are, maybe a little bit more movement. I would anticipate kind of like an EKG machine a little bit, that there'll be better months. But overall, if you were to look at the end of the year, I think we're probably going to be in the same place where we are now, just a lot of volatility at different times.
Yeah, a lot of volatility, a lot of uncertainty. I mean, it is a crazy time. There's always money to be made in all markets, which is encouraging.
100%.
It is some crazy times. So speaking of crazy times, I was hoping maybe between all the different types of deals you've done, maybe we could dive into something that was really unique or interesting or challenging besides my buildings. I know you got us across the finish line on two of my properties, which was a bit challenging for you guys, but you did it. But maybe we could dive into just like a case example of a cool, interesting project or deal that you might have done recently.
All right, let's pick one from residential space and we'll pick one from the commercial space. So that can give you a little bit of both sides. Um, what I do very well is I reverse engineer financing, which that means is I need to get the goal on the board, where we're trying to get to, and then kind of walk backwards in how we're going to get there. We had a transaction that we just closed. I want to say it's about 4.3 million or 4.4 million. And we had a borrower that was in the middle of three different things at the same time. He had a hard money loan coming due on two residential properties that were cross collateralized. One was being positioned for sale. One was still, they're trying to figure it out. They had another property that they were trying to buy also at the same time. So they had three transactions going on. I had a credit score, I want to say, we fixed the credit and we got to like 650. So we started way down there. And on top of it, I had a client that the tax returns weren't really reporting the income properly. I knew he was cash flowing, but showing the cash flow on bank statements and P&Ls or profit and loss statements versus tax returns, that's a whole nother ball game. Yeah. So we had to deal with a credit issue, with tax returns, income, three different properties, all that going at once, and a balloon coming up. And we managed to put together a very unique, I want to call it a bridge loan, but it was actually a permanent loan. This should have been a hard money loan at 9 to 10%, but we did it at, I think, 5.25%. And we put together this loan where we crossed all three properties, no prepayment penalty on them, took care of paying off all the loans, had enough cash out as well to complete the purchase of the other property, allow him to take title, allow him to have what we call release clauses for each property. So when he was ready to sell another property, it had a signed figure to it, and it wouldn't trigger the whole payoff of the entire loan. So basically, we gave him, I would say, a 4-course meal of financing. And we came through, and I think we did it in like 38 days or whatever was needed, and met everybody's timeline, and we pulled it off. Difficult, complicated. I mean, I happen to see more of the complicated stuff. I love easy stuff. It just doesn't show up as much. But that was one of the unique deals that we just did in the last, I would say, 60 days.
I'm glad you shared that with me. You know, your own sprinkling some JDM magic on that deal, because now I don't think my deal sounded so bad. You know, I mean, I don't know if I'm still one of the toughest deals after hearing about that one.
We'll leave that for off the camera.
Well, how about the commercial deal? What's a good example of that one?
So, commercial deal we've done in the last year. Some very large shopping centers, because in this COVID mix has been very complicated with retail. And last year we completed a $26 million purchase of a shopping center in a tertiary market that had rolling tenants and rolling, when I say rolling tenants, that means they had leases that were coming due. The majority of the property had leases that were only 1 year or 2 year. When it comes to financing like that, it's very complex. We were able to put together some financing that allowed them to first purchase the property. The purchase was 26 mil. We gave them a $20 million first second financing. What the owner wanted to do with that property was very unique. He wanted to buy the property. He felt this mall had a lot of great triple net pieces within the mall, a lot of triple net tenants, like Applebee's and Dunkin' Donuts and Buffalo Wild Wings and many other tenants. And his idea was a disposition, was to take the mall and break them into little triple net pieces and sell them one-offs. especially in this marketplace. And we were behind him on it. And we also gave him a $2 million line of credit to help whatever he needed in that perfection of that property. And so far over the last year, first of all, we got him into the property, and he's already been successful on some of the financing, on some of the sales there. He's already sold 6 or 7 pieces. He's already paid off, I would say, 45% of the debt, and realized the value of this property by another $8 or $10 million. And what's unique about that is where in a market like this, especially with COVID and all that, where things are very, very difficult, there's always a solution there. The question is how to get there. Are you willing to put in the time and the work and figure it out? And also on top of it, it's not always about rate. It's about terms. It's about structure. It's about what's going to get the deal done for both sides of the table. Financing, the lender wants to make sure that they're protected, but at the end of the day, your client, your borrower needs to make sure that whatever we're doing is successful for them, because financing makes the deal.
Yeah.
And that's really kind of what we're really good at. And I gave you big numbers, but we do loans for $200,000 and $500,000. I'm not motivated by the dollar amount. I get a high after still 16 years doing this on every deal, seeing it go through, looking at somebody and saying, hey, we got it done.
Yeah.
And that's what we're about, closings. That's really what we're all about here, closings.
Yeah. I love the reverse engineering idea too. Start with the goal in mind and come up with creative ways on how to get there most efficiently. I love it. I love it. So this has been awesome. Thank you so much for sharing all this. If people wanted to get in touch with you or your company, what do you think is the best way for them to reach out?
I mean, we're very active on LinkedIn. You can find Josh Moorvitch or JDM Funding on LinkedIn. I actually still give away my cell phone to everybody. If anybody who wants to reach me, I'm fine. Our office as well.
Well, this has been great, Josh. Thank you so much for sharing all your expertise, lending. As I've learned, it can make or break a deal like that. So really appreciate what you guys do. And I know you guys are a big help for a lot of people.
I want to finish with one thought, if I may, is that the mission statement of our company has nothing to do with financing. It's about people leaving our office in a better place. So not every deal gets done. It's impossible to do every transaction, but it's something about hearing somebody out, understanding what they need, sharing that thought. Maybe it's a referral, maybe it's an idea, maybe it's confirming the deal they already have is good. Yeah. You don't have to take everybody else's deal. It's about doing something good for everybody. And that's really, I think, the success to our company, success to myself has always been treating people right, both ethically and morally, and taking care of them. And I think that's just very important overall for business, is that money is important, the dollars and the bottom line is important, but it's about treating people right with respect. And that's really important as part of the pillar of this company.
Yeah, I love it. All right. Well, thank you so much for sharing.
You're welcome. Take care of yourself. Thank you for the opportunity.
As Josh mentioned, there's a lot of deals being done in multifamily buildings right now and a lot of opportunity. If you're interested in learning more, please check out csqproperties.com, or you can find us on Facebook and Instagram. Thanks a lot.